Welcome back to another deep dive. Today is Monday, February 2, 2026. And look, I don't want to be the bearer of bad news, but if you've glanced at your terminal or even just the notification center on your phone this morning, it is ugly out there.
Ugly is putting it mildly. The screens are just swimming in a sea of red.
It's a real bloodbath. We are seeing a broad market sell-off, but the specific pain point today, the real epicenter of the quake, is crypto. Bitcoin is sliding, the altcoins are tumbling, and caught right in the blast radius of this digital asset storm is a company that has, for better or worse, become the lightning rod for retail sentiment.
You're talking about Robinhood.
We are talking about Robinhood Markets, ticker symbol ACUTted. As we speak, the stock is down sharply, trading off about 8.8% intraday. It's hovering right around $90.77.
Wow, that is a significant haircut for a single morning's work. A really painful drop.
It is, and it forces us to ask the central question for today's deep dive. When you see a drop of this magnitude coupled with a crypto crash, the muscle memory from 2021, it just kicks right in.
Right.
You want to say, oh, look, it's just another meme stock doing meme stock things. It feels volatile, it feels fragile, but is that actually fair anymore?
That's the real question. Is that old narrative still true?
Right. Or, and this is the thesis we really need to test today, has this company actually matured into a legitimate value investment that is simply misunderstood by a panicked market?
I think that's exactly the right way to frame it, because when we combed through the source material, the 10Ks, the investor presentations, all the macro data, we found evidence suggesting we might be looking at what Warren Buffett would call a wonderful company.
A wonderful company. Okay, that's a big claim for Robinhood.
It is, but there is a catch. A big one. It appears to be a wonderful company currently trading at what you might call a euphoric price.
A wonderful company at a euphoric price. I love that setup because it implies a conflict, a real tension between the quality of the business and the valuation the market is putting on it. We're going to unpack exactly what that means.
Before we dive in, this analysis is brought to you by stockanalytics.ai. Get institutional-grade research on over 600 stocks for just $10 a month. Plus, request any ticker and download your own video analysis. Start your 7-day free trial at stockanalytics.ai. Now, let's get into it.
Okay, let's set the parameters for our mission today. We aren't just looking at the squiggly line on the chart. We are applying a forensic value investing lens, essentially the Buffett test, to Robinhood. And to do that honestly, I think we have to start by acknowledging the bias that exists in the room.
The 2021 hangover, it's real.
Exactly. Even now, in 2026, when I mention Robinhood to serious investors, they kind of roll their eyes. They still see it as that gamified app with the confetti designed to lure day traders into PFOFF payment for order flow traps.
The casino narrative. It's a very sticky narrative, and it's hard to shake.
It really is.
Yeah.
But the reality check here, and the sources are just emphatic on this point, is that the company has undergone a massive metamorphosis over the last 12 months, really since early 2025. It's not just a trading app anymore.
No, not at all. It claims to be a diversified financial ecosystem with, and this is the surprising part, shockingly high margins.
And we can't talk about any of this in a vacuum. We have to address the elephant in the room, the macro elephant.
The U.S. tariffs of 2025.
We have to discuss them. And we will get to that in the risk section, because that economic landscape has shifted under our feet, and those tariffs, well, they changed the game for disposable income and retail investors. But first, let's look at the machine itself. Let's see what they've built. Part 1, chapters 1 to 3, business, management, and financials.
Chapter 1, business understanding.
All right, let's start with the moat, the competitive advantage. For the longest time, the bear case was that Robinhood just had no moat. It was a commodity. Oh, you offer zero commissions? Cool. So does Schwab now. So does Fidelity.
And that was true initially. It was a valid criticism. They competed on price. But in business strategy, price competition is known as a race to the bottom.
You can't win that way long term.
You can't. If your only advantage is free, eventually someone else will offer free plus a toaster, What the data from late 2025 really shows is a strategic pivot away from commodity brokerage to something much, much stickier. They call it ecosystem lock-in.
Okay, ecosystem lock-in sounds great in a slide deck. It's a nice bit of corporate jargon. But what does it actually look like in the product? What does that mean for a user?
The cornerstone, the absolute foundation of this strategy is Robinhood Gold. Now, you have to stop thinking of this as just a premium tier where you pay to get lower margin rates or something.
Right, that was the old version.
That was the old version. In the value investing world, the comparison the analysts are making, and it's a lofty one, I'll admit, is the Costco membership model.
Costco, okay, hold on. I'm a Costco member.
Huh.
That model works because I pay $60 a year, and then I feel compelled to go buy 50 gallons of mayonnaise to make my money back. Does that psychology actually translate to a stockbroker?
It's a great question, and surprisingly, yes. It is the sunk cost fallacy, weaponized for engagement. You pay a fee to be in the club. Once you've paid that fee, you are psychologically incentivized to do all your financial business there to justify the cost.
You want to get your money's worth.
You want to get your money's worth. And the stats, they absolutely back this up. As of the third quarter of 2025, they hit 3.9 million subscribers to Gold.
3.9 million. And what was the growth on that?
That is up 77% year over year.
77%. That growth rate is absurd for a paid financial product.
Yeah.
Usually, people hate paying fees to banks and brokers.
They absolutely do. But here is the number that really matters, the one that tells the whole story. ARPU, average revenue per user. For the Gold platform, it surged 82% to $191.
Wait, pause there. $191 per user. So
Yeah.
the average Gold user is generating almost $200 a year for the company. That is Netflix-level revenue, but for a brokerage. How? What are they selling them?
Because once they pay that subscription, they aren't just trading. That's the key. They are moving their retirement accounts over to get the IRA match. They are holding their cash there to get the high yield on uninvested cash. And crucial to this financial lifestyle brand concept, they are using the credit card.
The Gold credit card. I feel like we saw those unboxing videos everywhere last year. But is it actually a business driver, or is it just a slick marketing gimmick?
It is a fascinating case study in psychology. It really is. They have about 100,000 active card holders as of the end of 2025. The mechanism is simple. You get 3% cash back on everything.
3% is really high. That's higher than Chase, higher than Amex for general spend. How is that sustainable for them? Is that a loss leader?
It is absolutely a loss leader, but it's a loss leader designed to drive asset gathering.
Mm-hmm.
But the genius of it, the truly clever part, is where the cash back goes. It doesn't go to your statement balance. It's not a discount. It goes directly into your brokerage account.
So I buy a latte for $6 and 18 cents just drops into my Robinhood account automatically.
Exactly. It gamifies prudent behavior. It turns spending into investing. Every time you tap that card, you are effectively buying a tiny fraction of a share of Apple or Nvidia. But think about the moat aspect here.
Go on.
If this card is in your physical wallet, the actual leather square in your pocket, Robinhood is no longer just an app on your phone that you check when the market is volatile.
Right. It's not just a notification.
It is a physical presence in your daily life.
Yeah.
It's how you buy your groceries. It's how you pay for gas.
That creates incredibly high switching costs. I mean, if I want to leave Robinhood now, I can't just click a button and transfer my stocks. I have to physically cancel my primary credit card, which hurts my credit score. I have to go change my auto pays on Netflix and Spotify. I have to move my entire IRA.
Precisely. It turns a click of a button departure into a weekend administrative headache, and most people will not bother. That is a moat, a real durable moat.
Okay, so they're building the moat. Let's shift gears to the revenue mix, because the other big knock on this company was that it was fragile. You know, if people stopped day trading meme stocks, the lights went out.
This is what I'd call the antidote to fragility argument. If you look at the 2021 version of the company, it was a one-trick pony. It was all about trading volume. Today, in 2026, the company has 11 distinct business lines. And the sources say each one of those lines is generating approximately $100 million in revenue.
11 different pillars. That sounds resilient,
Mm-hmm.
but we have to address the crash we are seeing today in the markets. Transaction revenue is still a huge chunk of their business, isn't it?
It is. You can't ignore it. Transaction revenue is sitting at $730 million. But here is the catch. It is heavily, heavily skewed toward crypto. Crypto revenue was up 300% to $268 million in the last quarter.
So when we see Bitcoin tanking today, when the whole crypto market is falling apart, that is a direct hit to one of their biggest growth engines.
It is. That is the risk. That's what you're seeing in the stock price today. The market is pricing in the risk of a crypto winter. However, and this is where the diversification really saves them, look at net interest income, or NII.
Okay, what are the numbers there?
That came in at $456 million, up 66%.
Explain NII for the listener who isn't a bank analyst. What exactly is that money? Where does it come from?
Think of it as float income. It's one of the oldest tricks in the book for financial companies. Clients have deposited $333 billion in assets onto the platform. A lot of that just sits as cash or cash equivalents.
Waiting to be invested.
Exactly. Or it's the proceeds from a sale. Robinhood takes that pile of cash and earns interest on it. In a high-rate environment, which we are definitely in, that acts as a massive hedge, a massive safety net.
So even if trading goes to zero tomorrow,
Even if trading goes to zero, that $456 million in interest income keeps flowing as long as the assets stay on the platform. It's a huge stabilizer.
so the trading volume is the icing, but the assets, the AUM, that's the cake.
That is a perfect way to put it, and they are expanding that cake aggressively, not just waiting for it to grow. We have to talk about the international news that dropped just this morning.
Right, the UK expansion. They just announced stocks and shares ISAs for UK customers. What is an IS?
This is a direct shot at the legacy UK platforms, the big old incumbents like Hargreaves Lansdowne. In the UK, an ISA is basically their version of an IRA or a Roth IRA. It's a tax-advantaged wrapper for your investments.
So this isn't for the day trader in London who's flipping stocks. This is for long-term retirement money.
Exactly. They are targeting passive wealth. Sticky money, money that gets deposited every month and just sits there for 20 or 30 years, compounding. It also ties in perfectly with their acquisition of Bitstamp, which gave them the regulatory footing in Europe. They are building a parallel ecosystem across the Atlantic.
And it's not just geographical expansion, it's demographic expansion too. I saw they acquired a company called Trade PMR. I'd never heard of them.
Right. And this might be the most un-Robinhood move they have ever made. Trade PMR is a platform for registered investment advisors, or RIAs. They manage about $40 billion in assets.
RIAs. That's usually for older, wealthier clients, right? The people who play golf on Tuesdays and have a guy who manages their money.
Correct. This is Robinhood moving upstream. It's incredibly strategic. They realize that their user base is getting older. They are getting wealthier. Eventually, those users might want a human advisor.
They graduate from the app.
They graduate. So by owning the platform that the advisors use, Robinhood keeps those assets in the family. It is a brilliant play to manage the wealth of the older generation and, more importantly, retain their own users as they age and their financial needs become more complex.
Okay, let's just step back and unpack this. They have the young traders. They are locking them in with credit cards and high-yield savings. They are grabbing retirement assets in the UK, and now they are building the back-end infrastructure for professional advisors who manage old money. It sounds like a remarkably mature strategy.
It is a very mature, multi-pronged strategy, which leads us to the people who are executing it.
Chapter 2, Management Evaluation.
Let's talk about Vlad Tenev, the CEO. I remember the congressional hearings in 2021. He looked terrified. He looked like a kid who'd been called to the principal's office.
He did. Vlad has had quite the evolution. If you go back to the IPO days, the biggest criticism of the management team was that they were reactive. They were constantly just putting out fires, platform outages, regulatory hearings, the whole GameStop fiasco.
It felt like they were always on the back foot, always apologizing for something. They were playing defense.
Right. But the 2025 version of Vlad Tenev is totally different. He talks about relentless product velocity. And when you look at the rollout schedule, it wasn't just talk. They actually delivered.
They did launch a ton of features last year.
The list is extensive. They launched Robinhood Legend, which is a desktop platform specifically designed to rival professional tools like thinkorswim from Charles Schwab. That was a clear move to recapture the pro traders who had graduated off the mobile app because it was too simple for them.
Then there were futures and index options.
Right, high-margin derivatives, products for sophisticated traders, and don't forget the prediction markets. They launched event contracts to capitalize on the 2028 election cycle and all the macro speculation. They are playing offense now, not defense.
It's a huge shift in posture. But the real test for us, looking at this through a value lens, has to be capital allocation. How do they treat shareholder money when they have it? Are they smart with it?
And this is where it gets really, really interesting. We have to talk about the buyback program.
The buyback. This was a huge move. Break down the math for me, because I think people might miss the timing aspect of this, which is the most important part.
It was a masterstroke of timing, an absolute clinic in capital allocation. The board authorized a $1.5 billion repurchase program. But they didn't just authorize it and sit on their hands like a lot of companies do.
They actually went out and did it.
They executed it aggressively when the stock was beaten down, when no one wanted it. By April 2025, they had bought back 20 million shares.
And what price did they pay? That's the key number.
The average price was $33.40.
Okay, let's stop and just look at that number for a second. $33.40. And today, even with the market crashing, we are trading at $90.77.
Exactly. Do the math. Management effectively bought out partners, shareholders who wanted to leave at roughly 37% of today's market value. That created massive tangible value for the remaining shareholders. It showed supreme confidence when the market was scared. It's the ultimate buy low maneuver.
It is the Buffett way. Be greedy when others are fearful. But we have to look at the other side of that coin, because if they were buying low then, what are they doing now at these higher prices?
This is the insider trading nuance, and it's something you have to pay attention to. While the company was buying hand over fist at $33, look at what the insiders are doing right now. We have reports that CEO Vlad Tenev sold 375,000 shares on January 5, 2026.
And he's not the only one.
No. The CTO, Jeffrey Pinner, has also been selling.
Now, to be fair, these are usually pre-planned, right? He didn't just wake up on January 5th and decide to hit the sell button in a panic.
That's right. They are pre-planned. They are Rule 10b5-1 plans, which are set up months in advance. And in this case, they were set up back in September 2025. But that context is what matters. They set up the plans to sell after the stock had rallied significantly from those lows.
So the interpretation is they were ecstatic to be buyers at $33, but they're very happy to be sellers at $90 plus.
It strongly suggests that management views the current price as full, or maybe even frothy. They are taking chips off the table. It is a signal we shouldn't ignore. If the guy running the company is selling, you probably shouldn't be mortgaging the house to buy.
A very prudent point. Let's touch on governance quickly. We have a changing of the guard at the CFO position.
Yes, Jason Warnick is retiring. He is the guy who really guided them to profitability, so he will be missed by investors who followed that story. But the appointment of Shiv Verma seems to signal continuity.
So no big shakeup in strategy.
It doesn't look like it. The focus remains on growing EPS and free cash flow per share. That's the language of value creation. It doesn't look like a change in philosophy, just a natural succession.
Okay, so the management seems solid, if a bit bearish on their own stock price right now. Let's get into the hard numbers, the scorecard.
Chapter 3. Financial health.
We mentioned the profitability pivot earlier. There was an old bear case, I remember reading it in the Wall Street Journal back in 2022, that Robinhood could never actually make money, that the business model was flawed, it was all venture capital subsidies, and once they had to stand on their own, they'd collapse.
That narrative is officially dead, buried. We have to look at the Q3 2025 earnings snapshot. It just completely debunks that idea. Revenue hit $1.27 billion. That's up 100% year over year.
Doubling your revenue at that scale is impressive, but what about the bottom line?
Net income was $556 million.
So they are solidly profitable.
Very. But raw numbers are great, but let's talk margins, because that is where the quality of the business really shows up.
And this is the jaw-dropping stat. The net profit margin was 43.7%.
43.7%. That's just incredibly high. For context for everyone listening, a grocery store makes maybe 2%. A car company, if they're lucky, makes 8%. That's like Visa or MasterCard levels of profitability, software level margins.
It is, and it speaks to a concept called operating leverage. This is something listeners really need to grasp to understand the economics of a digital business like this.
Break it down for us. What is operating leverage in this context?
Okay, imagine you own a coffee shop. If you want to sell twice as much coffee, you probably need to hire another barista, maybe rent the space next door, buy another expensive espresso machine. Your costs go up as your revenue goes up.
Right. It's linear. More sales equals more costs.
But Robinhood is a digital platform. The cost to add the 4 millionth user is essentially zero. They don't need to build a new branch in a new city. They don't need to hire a new advisor for that specific person. The server space costs pennies.
So their fixed costs, the engineers, the headquarters, the legal team, all that stays the same. But the revenue doubles on top of that fixed cost base.
Precisely. The data shows expenses only grew 31% while revenue doubled. That gap, that widening jaw between the revenue line going up and the expense line staying relatively flat is pure profit generation. It drops right to the bottom line. That is operating leverage in action.
What about the safety net? The balance sheet. Because if we are heading into a tricky economic period, which it feels like we are, cash is king.
It is a fortress. They are sitting on $4.3 billion in corporate cash. To put that in perspective,
Hmm.
they could generate zero revenue for 2 full years and still cover all of their operating expenses.
That is a very comfortable cushion. That's a lot of runway.
A huge amount. And then there is the total platform assets figure, $333 billion. That is up 119% year over year.
That growth rate is faster than their user growth, isn't it? I remember user growth was closer to the high single digits.
Much faster. And that is the key takeaway from the asset number. It proves the wallet share strategy is working. Users aren't just opening accounts anymore, they are depositing more money. They are trusting the platform with a larger and larger percentage of their net worth.
So they're winning trust. Okay, so the engine is efficient, it's highly profitable, and it's well capitalized. But now we have to play the valuation game. Because even a Ferrari is a bad investment if you pay $1 billion for it. What is this thing actually worth?
This is where we have to be the sober adults in the room. We need a valuation reality check. We ran a DCF, a discounted cash flow analysis, to try and get to a real number.
Walk us through the inputs and be honest, did you cook the books to make it look good, or were you conservative in your assumptions?
We tried to be conservative but fair. First, for revenue growth, we assumed 12% growth for the next 5 years.
12%. They just grew revenue by 100%. 12% seems incredibly low, almost pessimistic.
It might seem low, but remember, we have crypto cycles. Crypto might be down 50% next year, for all we know. And we have the tariff headwinds, which we will discuss later. We have to account for the cyclicality of the business. You simply cannot extrapolate a boom year forever into the future.
That's a fair point. Okay, what about margins?
We assumed a 35% free cash flow margin long term. That is slightly lower than their current net margins to account for taxes and capital expenditures. Maybe they need to buy more servers or acquire another company down the line.
And the discount rate. This is the number that accounts for risk and the time value of money.
We used a 12% discount rate. In a world where the 10-year treasury is yielding over 4%, and considering this is a volatile stock in a cyclical industry, you need a high hurdle rate to justify the risk.
So you put all that into the blender, 12% growth, 35% margins, 12% risk rate. What is the number? What's the intrinsic value?
When you crunch those numbers, the intrinsic value comes out to approximately $35.11 per share.
Whoa, $35.11.
And the stock is trading today at $90.77.
That is a massive disconnect, a chasm. The market is pricing it at almost 2.5 times its conservative intrinsic value.
Exactly. Buying at $33, where management bought back their own shares, was a value move. That was buying $1 for 50 cents. Buying at $90 requires perfection. It requires believing that growth will accelerate and never stop, and that the macro risks we see on the horizon won't materialize at all.
So we have a wonderful business, but the price tag is, let's just say it's ambitious.
Euphoric is the word I would use. The price is euphoric.
Part 2, chapters 4 to 7, market sentiment, ownership, risk, and final conclusion.
Chapter 4, market sentiment.
We have established the numbers, the fundamentals, but the market, especially with a stock like Hood, is driven by emotions, by narrative. We have to talk about Mr. Market's mood swings.
And with Robinhood, Mr. Market is truly manic depressive. The volatility is extreme. The swings between fear and greed are just wild.
Let's look at the bull narrative first. What are the optimists seeing that justifies $90 or even $100 plus? Because somebody's buying at this price today.
The bulls see the Charles Schwab of Gen Z. That's the narrative. Their thesis relies heavily on the great wealth transfer. We are talking about trillions and trillions of dollars moving from boomers to millennials and Gen Z over the next 20 years.
And since Robinhood basically owns that demographic, they're positioned perfectly.
Exactly. The argument is that assets under management, or AUM, will balloon naturally just by gravity. They don't even need to do any more marketing. They just need to wait for their users to inherit money from their parents.
Plus, there's the crypto factor, which is a huge sentiment driver.
Right. There's an optimization argument that if crypto stays hot, if we get another massive bull run, earnings could theoretically hit $10 a share. If you believe that, then $90 looks cheap. It would be a 9x PE ratio, but that is a very, very big if. It requires the crypto bull run to never end.
Okay, that's the bull case. And the bears. What is the counter argument to that?
Valuation vertigo. That's the bear case in 2 words. The bears point to the price-to-sales ratio. It is sitting at a staggering 23x sales.
23 times sales. That is huge for a financial company.
The 5-year average for the stock is 7x, so it is trading at more than triple its historical average valuation. The bears argue it is priced like a SaaS company software as a service with recurring guaranteed revenue. But it's not. It's a cyclical brokerage.
Revenue is not guaranteed.
Not at all. If a crypto winter hits or a deep recession, that revenue drops off a cliff. It doesn't recur.
So the bear price targets are significantly lower.
Around $90 is the optimistic bear case, which basically implies zero upside from here. Many see it going much, much lower, back towards that $35 intrinsic value we calculated.
What about the sentiment indicators? Are people betting against it? Is there a big short position?
The short interest is at 4.34%. I'd call that a Goldilocks number. It's not high enough to trigger a massive short squeeze, so don't bet on a GameStop 2.0 situation here. But it is high enough to show that smart money is hedging. They are nervous about the valuation at these levels.
And what about the users themselves, the Robinhood Investor Index? What does that tell us?
This is a critical risk factor that I think gets overlooked. The index shows that Robinhood users are heavily concentrated in high beta tech stocks. Tesla, Nvidia, the exciting growth names.
So there is a massive correlation risk.
A huge one. If the tech sector, particularly the NASDAQ, crashes, Robinhood users lose their buying power. If they lose buying power, they stop trading. They might even have to sell to meet margin calls. If they stop trading, Robinhood loses revenue. It is a dangerous feedback loop.
Okay, let's see who actually owns the company now that it's more mature.
Chapter 5, Ownership Structure.
This has shifted a lot since the IPO. I remember it used to be all retail flippers and venture capitalists.
It has, dramatically. We call this the institutional pivot. The shareholder base is moving away from that hot money and toward what you'd call permanent capital.
The big three index funds.
The big three. Vanguard owns 10.5%, BlackRock has 6.6%, State Street has 3.5%.
So roughly 20% of the entire company is locked up with the big index giants.
Which is actually a good thing for stability. It means Robinhood is now a staple in major indices like the S&P 500 and various ETFs. Those funds have to hold it. They are indiscriminate buyers and holders. It provides a price floor and tethers the stock to the broader market flows rather than just the whims of retail sentiment.
But there is still some innovation money in there too, right? Some of the more aggressive growth funds.
Yes. Kathy Wood and ARK Invest, reports are coming out that she is buying the dip even today amidst this 8% crash.
She is doubling down at $90.
She is. Her thesis is completely different from a value investor's. She sees Robinhood as a convergence play. To her, it's not a broker. It's the intersection of AI, digital wallets, and DeFi, decentralized finance. She believes it is the future interface of money. If she is right, then the premium valuation is justified.
It is a high conviction bet on the future. But we should remind listeners about the control aspect. The founders still run the show.
A crucial point. Vlad Tenev and Baiju Bhatt still hold Class B shares. Those carry 10 votes per share versus 1 vote for the Class A shares that you or I would buy.
So they have total control no matter what the big institutions think.
Effectively, yes. It is a dual class structure, and it's a double-edged sword. On one hand, it protects them from short-term activist pressure. They can ignore Wall Street's quarterly demands and build for the next decade. On the other hand, if they pivot in the wrong direction, shareholders have no recourse. You're just along for the ride.
Speaking of being along for the ride, let's take a quick pause. If you are enjoying this deep dive, make sure to like and subscribe to Stock Analytics AI.
And if you want to go deeper than just this one analysis, listen to this. Want institutional-grade stock research without the institutional price tag? Check out stockanalytics.ai. For just $10 a month, you get full access to our deep dive video library covering over 600 S&P 500 and NASDAQ 100 stocks, each with full source citations you can verify. Can't find the stock you're looking for? Request analysis on ANY ticker and download your own video within 24 hours. Upgrade to Pro for $20 a month and unlock our SEC risk scanner, which detects red flags in company filings before they hit the headlines, plus our portfolio diversification analyzer to optimize your holdings. Start your 7-day free trial today at stockanalytics.ai. Make smarter investment decisions with research you can trust.
Okay, we are back, and we have arrived at perhaps the most critical section for any investor looking at 2026. We can't look at Robinhood in a vacuum. We have to look at the water it's swimming in, and that water is getting very choppy. We mentioned the tariffs at the top of the show, the U.S. tariffs of 2025.
Chapter 6, Risk Assessment.
This isn't just a political talking point anymore. It is an economic reality that is hitting people's wallets.
It is the defining economic stressor of 2026, without a doubt. The data is stark. The effective U.S. tariff rate is now 17.9%. That is the highest it has been since the 1930s.
Smoot-Hawley territory. That's not a comparison you want to hear.
Not at all. And
Uh,
that hits the consumer directly in the wallet. Prices are up about 1.7% across the board because of this. But the metric that matters for Robinhood, the one that keeps me up at night regarding this stock, is household disposable income. It is down by an estimated $2,400 per year.
$2,400? That is a lot of money for a young family or a young professional. That's a vacation. That's a few car payments. That's your entire emergency fund contribution for the year.
It is huge. And we need to trace the transmission mechanism. How does a tariff on imported steel or electronics actually hurt a stockbroker?
Connect the dots for us. Because intuitively, I might think, well, they just trade stocks. They don't buy steel.
It is all about where the liquidity comes from. Who is the Robinhood user? They are Gen Z and millennials. What do they spend their money on? They spend heavily on durable goods and tech, electronics, cars, apparel.
The exact sectors that are most impacted by tariffs on imported goods.
Exactly. So let's play it out. You're a Robinhood user. You want to buy the new iPhone or maybe a new Tesla. Because of tariffs, that item now costs 20% more than it did 2 years ago. You still buy it because you need a phone or a car, but that extra money has to come from somewhere.
It comes out of my savings, my investment contributions.
Right. That is $2,400 that is not going into your brokerage account. That is $2,400 fewer dollars available to buy stocks or speculate on crypto. It is a direct drain on the fuel tank that powers Robinhood's entire engine.
And it triggers other problems too, right? If prices are up across the economy, the Fed can't exactly step in and cut interest rates to help out.
Correct. Tariffs are inflationary. Because prices are up, the Fed has to keep rates high to fight that inflation. That's why the 10-year Treasury is sitting at 4.25%. They have no room to maneuver.
Now, earlier we said high rates help Robinhood's bottom line because they earn interest on client cash.
They do help the company's income line, but they hurt the user's balance sheet. It's a double-edged sword. High rates mean high margin rates. It costs more to borrow money to trade. It means high APRs on that fancy gold credit card. It squeezes the user from both sides. The goods they buy cost more, and the debt they carry costs more.
So far, though, retail has held up remarkably well. We haven't seen a mass exodus from the market.
And we call this the resilience paradox. In 2025, retail investors kept buying the dips. They viewed the market as the only way to outpace the inflation they were seeing everywhere else. Their logic was basically, if my cash is losing value in the bank because of inflation, I have to be in stocks to survive.
But there is a tail risk. There's a breaking point. What happens if the economy actually snaps under the weight of these tariffs?
The tail risk is recession. The Yale economic model predicts that these tariffs, if they stay in place, could push unemployment up by 0.7%. If people start losing their jobs, the deposits don't just stop, they reverse. The withdrawals begin.
People liquidate their stocks to pay rent and buy groceries.
Precisely. The resilience paradox breaks. And at an $82 billion valuation, the stock has absolutely no buffer for that scenario. It is priced for a soft landing, not a tariff-induced recession.
That is a very sobering thought. So what does this all mean? Let's bring it all home.
Chapter 7. Conclusion.
We have covered a lot of ground today, from 11 distinct revenue lines to the complexities of global trade wars. Let's try to synthesize this into a clear takeaway.
The good is undeniable. I think we've established that. Robinhood has a real moat now with the gold ecosystem. It has structural profitability with those beautiful 43% margins, and it has demonstrated sound capital allocation with the buybacks down at $33.
But the bad is just as clear.
The bad is the price. The valuation is extreme. We are looking at 2.5 times its conservative intrinsic value, and the macro risks, specifically the tariffs hitting disposable income, are rising, not falling.
So if we go back to the Buffett test we started with.
The Buffett verdict is clear. He famously said, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price.
And Robinhood, where does it fall?
Robinhood is now a wonderful company. I think we can say that with confidence, but the price of $90.77 is euphoric. It is not a fair price.
So what is the final recommendation for someone listening right now?
The status is fundamental, hold, valuation, sell.
Explain what that means for the listener. What's the action?
If you already own it, if you got in at a lower price, hold it. It is a compounder. It is a winner. Don't sell just because it's pricey, because winners tend to keep winning for longer than you think. But do not add new capital here. Do not start a new position at this price.
Stay on the sidelines with your cash.
Exactly. Patience is key. Wait for this manic market to eventually turn depressive, as it always does. We need a margin of safety. Look for a pullback to the $50 to $60 range.
$50 to $60. That is the buy zone.
That is where the math works. That is where you are protected against the tariff headwinds and the potential for a crypto winter.
That makes a lot of sense. Before we sign off, I want to leave you with one final provocative thought to chew on. We talked about the credit card and the ISAs and the checking accounts.
The ecosystem, the lock-in.
Right. Think about that psychological lock-in. If Robinhood becomes your bank and your broker and your credit card, does the stock price even matter in the short term? Or have they already won the war for your wallet? If they become the default operating system of your financial life, maybe the company's success is just inevitable, regardless of these valuation swings.
That is the trillion-dollar question.
Thanks for listening. Don't forget to like and subscribe to Stock Analytics AI for more deep dives.
And remember, this analysis was generated using AI-assisted research tools and is for informational purposes only. It does not constitute financial advice. Always do your own due diligence.
See you next time.